Ethereum's blistering 50% two-week rally, driving the price to roughly $3,770, has reignited debate over whether a $9,000 target is realistic or merely wishful thinking on one hand. ETH remains 23% below its all-time high from November, suggesting plenty of room to run if bullish catalysts align. Glassnode's MVRVZ score confirms that valuations are still modest compared to prior tops, indicating that Ethereum is undervalued relative to the actual capital deployed on the network. Bitcoin's 74% gain over the past year, coupled with ETH's 28% loss, underscores the recent underperformance of Ethereum. It also highlights how capital may quietly rotate back into the second-largest blockchain as risk appetite returns. Analytical teams at Bitcoin Vector argue that this under-ownership creates a setup for a powerful catch-up move, especially if institutional flows and on-chain demand continue to rise from a technical standpoint. $4,000 stands as a key psychological and chart resistance, a decisive break above this level would likely trigger algorithmic buying and fresh entries from momentum traders, paving the way for the next acceleration phase. Elliott Wave adherents at X-Force Global have mapped out an emerging third wave, historically the most explosive leg of a five-wave bull cycle, projecting a potential $9,000 peak by early 2026. That target derives from Fibonacci extensions of prior waves and aligns with the pattern of steep parabolic gains, typical of Wave 3, of course. Elliott counts are inherently subjective and prone to revision. If price action deviates, a trimmed or truncated third wave would invalidate lofty targets and potentially lead to a shallow correction, rather than a full throttle surge. In chain indicators lend further weight to the bullish thesis. Nearly 34 million ETH, or 28% of the total 120.7 million supplies now staked, effectively locking long-term capital out of circulation and creating a persistent supply squeeze. Exchange balances are at their lowest since 2016, with just 16.2 million ETH held on platforms, signaling reduced liquidity on the sell side. Meanwhile, short-term holder balances have jumped 16% in July, marking a fresh influx of new market participants eager to grab ETH on the rise. When combined with over $4 billion in inflows to spot ETHs in the last 2 weeks, ETH flows paint a picture of growing institutional conviction, yet high realized profit levels. 94.4% of supply is in the money could prompt profit-taking, especially as NUPL hovers in the optimism hesitation zone at 0.47, well below Bitcoin's 0.57. In other words, Ethereum still has headroom before euphoria sours sentiment, but the proximity to historic profit thresholds also creates risk of near-term corrections. Ethereum's technical backbone has also been strengthened by successive gas limit increases, most recently in July, which lifted per-block capacity higher as Layer 2 solutions absorbed the bulk of activity. Average fees have fallen to just 0.0004 ETH per transaction, an all-time low, yet gas consumption remains near capacity, reflecting robust use of decentralized applications, scaling infrastructure, and novel primitives like modular rollups and data oracles. This contrasts sharply with the NFT-driven congestion of 2021, signaling that Ethereum's value proposition is maturing beyond speculative minting toward real world use cases, stablecoin rails, DeFi lending, and on-chain automation. However, one must acknowledge emerging competition from alternative smart contract blockchains that offer similar or better performance metrics if developers and users migrate en masse. Ethereum's flow of real economic activity could be diluted, undermining the fundamental demand underpinning a $9,000 price macro. Tailwinds also matter. A dovish Fed pivot or signs of slowing U.S. inflation could reignite broad risk asset rallies. Lifting crypto alongside equities. Institutional adoption of Bitcoin set the stage. Ethereum is next in line as a programmable digital commodity, yet any macro reversal, like a surprise rate hike or credit market stress, could trigger risk-off selling that cascades through crypto markets, snapping leverage positions and dragging ETH below key supports. The interplay between macro liquidity and Chain demand will be a decisive factor in whether Ethereum's price chart can sustain a parabolic trajectory risk. Management is therefore non-negotiable. Traders aiming for a $9,000 payoff should consider staggered entries around proven supports such as $3, $400 and $3,000 while using tight stop losses if price fails to hold those levels. Option strategies, like call spreads near the anticipated breakout zone, can lock in upside participation while capping downside. Long-term holders may choose to dollar-cost average, viewing current levels as attractive relative to projected long-term fundamentals, but should be prepared for interim drawdowns of 20 to 30% typical of extended bull runs. Diversification into Layer 2 tokens and Ethereum-based DeFi projects can also hedge pure ETH exposure, capturing network growth beyond the base token. In sum, the case for a $9,000 Ethereum hinges on a confluence of bullish technical setup, tightening supply, fresh institutional and retail flows, and sustained on-chain activity factors that collectively support a doubling from today's price. Yet significant caveats remain. Valuation metrics must improve beyond prior cycle highs. Macro volatility needs to align. Competitor blockchains must not erode Ethereum's network effects, and leverage sentiment must avoid premature exhaustion. The path to $9,000 is neither straight nor guaranteed, but for those who can balance optimism with disciplined risk controls, the coming months could present a historic betting window on Ethereum's next descent.